Hello again, everybody. I think a lot of us know approximately the time frame when baby boomers were born. Just as a reminder, that was 1946 to 64 when 76 million of us came into this world. And I say us because I barely squeezed in there at the end. So yeah, I'm one of the younger boomers. When I first got into this business, I was told, and I read too about this a lot from economists and market prognosticators, hey, decades from now, be careful because the boomers who are only now in their 30s and 40s, that shows you how long I've been in the business, they're only in their 30s and 40s, but decades from now when they start to retire, it's going to have a major negative impact on the financial markets and the stock market in particular. Why? As the saying goes, and it made sense at the time, because they'll retire and they'll start selling all their stocks. They're not going to be in the growth mode anymore. They will be in the distribution mode. Sell equities, buy bonds and CDs and all that. Okay. Well, fast forward, just like that, man, we are here. Boomers now have been retiring for at least about the last 10 or 15 years, and that's going to continue for some time. And guess what? There's been no market correction due to that. In fact, let's go to the chart right now, and you can see the Dow Jones Industrial Average. 15 years ago, as the boomers first started to retire, and that is a market that is going up and to the right, up and to the right. Isn't that amazing? Where is the flat line? Where is the market coming down? Yeah, my friends, we'll get another bear market someday, somehow, but it's not going to be because of what we were told was going to happen. That 76 million Americans were going to start selling all of their stocks. Isn't that amazing? Now, I've had a front row seat to this the entire time, helping my fellow boomers save for retirement, invest for retirement, and then into the distribution mode. So what happened? How did the prognosticators get all of this wrong? Because it seemed to make sense from decades ago that would say, hey, you have to get more conservative, right? You have to change your allocation. So exactly what happened? Well, think about this. This is where people got it wrong. It's not like, let's say I'm going to turn 65 and I'm going to retire tomorrow. And I'd say, hey, you know what? I've had 80 to 85% of my investments in the stock market all this time, right up until the moment I retire. And by the way, I'm retiring now at 65. So next week, I'm going to cut that in half and I'm going to be 40% in stocks. That's not how the game is played. What you usually see occur is people are changing allocations slowly over time. Someone who's still working at 60 years old is not investing the same way he or she was at 35. It's just kind of a slow progression that I think a lot of these demographic folks and market prognosticators got wrong. Now, look, this is from my experience, and I went down and I listed the reasons why the stock market has not been impacted by tens of millions of boomers retiring and supposedly putting pressure on stocks. 5 reasons. Here we go. Number 1, we are living longer. Now, I know that there have been some recent figures that show that maybe life expectancy in this country has come down a little bit. That is true, but it's a little bit misleading. First of all, those numbers still include COVID deaths, but we're really through that now. But one thing that's continuing is, unfortunately and tragically, a lot of our younger people are dying because of opioid abuse, because of teen suicide. Once you get through that and you get to age 50, your life expectancy isn't in the 70s, as it is now when we count from birth 0. Once you get to 50, your life expectancy is now well into your mid-80s for both men and women. So that's number 1. People, when they retire, know they're living longer than the generations before them, and so they have to plan accordingly. That fits into number 2, which is inflation. You know, the best performing asset class when it comes to battling the negative impacts of inflation historically is, of course, equities. Stocks. It's the best place to be long-term to battle against inflation. And boomers get it as they're retiring, and their financial advisors too, so they're staying more invested in equities than perhaps their predecessors in generations ago. Number 3, dividends. This is a big one that I don't think people ever quite understood back in the day. You need total return, kind of fits into the first two, all right? To battle inflation, you need some growth, but also if you're going to live a long life, you want dividends that are growing. Yes, have your bonds, have your CDs, have the conservative stuff, but that is impacted by prevailing rates. With good blue chip stocks that raise dividends every year, no matter what the economy is doing, that also helps you battle against inflation. Number 4, Americans are working longer. Hello. Back in the day, you retired at 62, maybe 65. You had within 10 years to live, and that's how you planned. Not anymore. Americans are working longer, sometimes because they have to, but other times because I'm so healthy, let's say, in my 60s. And what else would I do with my life? I'm not killing myself in the corporate world anymore, but I'm doing this little part-time thing on the side, and that's still giving me income, and I'm living longer. And by the way, there are many Americans in their 70s still contributing to a 401k plan. That also helps the stock market, of course. And then lastly, number 5, heirs and beneficiaries. So, this is how this is working, especially with a lot of wealthier Americans, because this is what I see in my little corner of the world all the time in my practice. Look, Dave, I have my investments here that I need for myself to make sure that I can maintain my lifestyle in retirement. It's paying a certain amount of cash flow income for me, but all this other money that I have, I'll never spend it. I already know that's going to my kids and grandkids. I would like you to invest with that in mind. So there you have it. We're not investing anymore for that 75-year-old who might have 10, 15, 20 years. No, we're now investing with a little bit more of a growth bent for money that's eventually going to go to those kids and grandkids. Again, something that really wasn't in place some 30 years ago. Now, there are other reasons why this phenomenon is happening, but those are the 5 main ones that I've come up with. So please, don't believe any of the headlines, which I'm amazed they're still out there. They still exist. Even though this has just totally been dismissed by reality and of somehow boomers retiring will have a negative impact on the market. It hasn't been happening for 10 or 15 years. You saw the chart. In fact, the return of the market the last 15 years is higher than the long-term 100-year average, while boomers are retiring and supposedly selling, which they are not. And they are not going to. So I get back to, please do not believe the headlines about this. You stay invested long term. Yes, my friends, we will have a bear market, and we're going to have nasty bear markets over the next couple of decades. That's inevitable. But bear markets usually start because of some Fed mistake, some monetary mishap, some bad policy, or geopolitics. Those are the 3 reasons why bear markets start. Never because of demographics, and never because of boomers like us. All right, I hope that helps. Please pass this along to others you might feel could benefit from the information here. And as always, if you haven't done so, please hit subscribe. We'll see you again next week.